Our last inflation report came in cooler than expected, which naturally has some people excited, claiming the win on the inflation fight, which then poses the next natural question. If inflation is falling, does that still mean that we're going to see a recession? And what's interesting is just a few days after the inflation report came out, we had another report come out by the Federal Reserve Bank, the Fed meeting minutes, which for the first time, I'm going to emphasize this, for the first time ever, now, the Federal Reserve Bank stated that they believe that we are going to enter a recession by the end of 2023, and then we're going to spend the next 2 years recovering from this recession. The reason why this is so significant is because, well, the Federal Reserve Bank is a central bank here in the United States, and because they've never said that we are going to enter a recession. Up until just not that long ago, they kept saying that a recession can be avoided. We're going to be able to avoid a recession. It's not likely that we're going to see a recession. And then they kept saying that if we were to see a recession, that it would be very mild. Now you're starting to see that shift in tone where they're saying that it's very likely that we're going to enter a mild recession by the end of the year. So you can start to see that change in tone, which is kind of like what we've been seeing happen, because it all started with the Federal Reserve Bank saying there's not going to be any inflation. Then it was the inflation's transitory. Then it was, okay, it's not so transitory, but it's under control. Then it was, this inflation is way too high and we got to bring it down. Then it was, we're going to bring the inflation down easily without causing any recession. Then it was, yeah, we're going to bring the inflation down. Maybe we might see some sort of soft landing. Now it's, yeah, we're going to bring inflation down, but it is going to cause a mild recession. So you can start to see the shift in tone over the year. And to be fair, not everybody agrees with the Federal Reserve Bank. We have people that disagree with the Fed who say that we're not going to see any sort of recession because the government immediately came out after the Federal Reserve Bank statement and they said, no, our economy is too strong and there's no recession in sight. That's why today what I want to do, I know this is a little bit of a long video, but I'm going to go over a bunch of different topics. I want to start by talking about inflation and dive deep into inflation. After inflation, I want to talk about the economy, what's going on with the economy, what you need to expect, what you need to do. And then third, I'm going to touch on a topic called De-Dollarization, which has been picking up a lot of steam. I've been talking about this for a while now, but we're starting to see more and more things happen that I want you to understand what's going on instead of getting really just fueled by emotions, because I think that's what a lot of the traditional media is just talking about it in a very emotional sense, but I rather want you to understand what it actually means and what you can do about it. So let me start by talking about inflation and what's going on with inflation, because in the most recent inflation report that we got, it said that inflation, our headline inflation, came in at 5%, which is the lowest inflation number that we have seen since 2021, which is good news. That means inflation is lower today than where it was a little while ago. Now, there's a couple things that I want to clarify with that. Number one is the difference between deflation and disinflation. Because while inflation has fallen from 9 point some percent to 5%, that doesn't mean that the price of things are falling. It just means that the price of things aren't growing as quickly as they were before. Before, things were growing at, on average, according to inflation, 9%. Now inflation says that the price of things are growing at 5%. So that doesn't mean the price of things have fallen. It's just that they're not growing as fast as they were before, but they're still growing extremely fast. Remember, the Federal Reserve Bank's target on inflation is 2%. And when you have 5% inflation, that's still more than double what the Federal Reserve Bank is aiming for. The second problem is that this 5% inflation is very fast, and it's too fast even for the Federal Reserve Bank. The Federal Reserve Bank has even come out and said that this 5% inflation is still extremely high. Now, the thing that I want you to understand about this is a lot of this data that we get is lagging, meaning it comes after a period of time, because the inflation data that we have right now is for the previous months based off of previous data. But if you look at what's happening right now, there are some significant and interesting factors that are happening that you want to pay attention to. And number one has to do with the housing market, because what we saw happen up until just recently, we had been seeing home sales and home prices fall month after month after month. But then when we saw the banking crisis hit, when we saw the Silicon Valley Bank issue happen, we saw interest rates fall because the whole credit crunch was happening, and that also pulled mortgage rates lower. Now, when mortgage rates went lower, we saw this huge flood of borrowers. People who wanted to buy a home go out and say, oh my God, mortgage rates fell from 7% to around 6%. Let me go out and take advantage of these lower mortgage rates and buy a home. Because when you buy a home at a 6% mortgage, it's cheaper than a 7% mortgage. So you saw this huge flood of people wanting to go out and buy a home, which meant that the home sales, the amount of homes that were selling, also started to skyrocket. Now, what does that mean? When you have more buyers than sellers, because now when you have more home sales, the demand starts to shoot up. Now, the people selling their homes are saying, wait, did I just get 8 offers on my home? Now you have that bidding war situation, and now you see home prices start to rise again, and that's exactly what we saw happen. Just recently, the reports came out that we have been seeing home prices rise for the first time in a long time. Why did home price suddenly start to go back up? Well, because interest rates, well, mortgage rates more specifically, fell for a little period. Now, the reason why this is significant, going back to the inflation number, is because one of the biggest impacts on the CPI is the headline inflation number. One of the biggest impacts on CPI is the housing market. Now, while they don't look at housing prices directly, they indirectly look at the housing market. And now, if home prices start to rise, it's good if you're a homeowner, but when you're the Federal Reserve Bank trying to fight inflation, and now this big factor in inflation, the housing price starts to rise as opposed to fall, that's going to put upward pressure on the CPI, which means that could force the Federal Reserve Bank to have to get even more aggressive on the inflation fight. Now, we did a whole deep dive of this on Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs, I highly recommend you do so, because it's an easy and free way for you to stay up to date on what's happening in things like the housing market, the Federal Reserve Bank, the economy, the global economy, the stock market. It's easy to read, it's a quick breakdown of what's happening, and it's completely free. So if you want to join Market Briefs, I got the link to how you can join for free down in the description below. But this is where now, as home prices are rising, the question is going to be now in the coming inflation reports, how is that going to affect inflation? Because if we see a U-turn inflation and inflation starts to rise next month or the month after that, what is that going to mean for the Federal Reserve Bank? And what's that going to mean for the fight on inflation, and how will that impact the economy? I'm going to get to all of that. The second thing that I want to touch on when it comes to inflation has to do with oil. And the reason I want to talk about oil is because, well, oil prices have come down very significantly off of their peak. If you remember when the pandemic hit in 2020, we had this huge drop in oil demand. Factories were shut down, planes were not flying, people were not driving cars. So the demand for oil and energy just sank. And now, again, let's go back to supply and demand. We have the supply of oil, but now no demand. And we saw the price of oil and gas plummet. Now what we have been seeing happen, well, let's go back to there. After that shift, we then started to cut the supply of oil because there was no need for it. And then you saw the reverse happen. The supply of oil got cut. Now you have not that much oil. And then the demand for oil started to shoot back up. People started traveling again. People started going out again. People started driving again, started going back to work again. Manufacturing plants started to open again. Now the demand for oil starts to rise while the supply of oil is down here. And that was when we saw the expensive gas all around the country because we had low supply but high demand. Then that started to regulate and things kind of calmed down in the oil market. But then, now we'll get to where we are now. In April of 2023, we saw this sudden shift because the OPEC countries came out and said that they wanted to cut the production, aka supply of oil. It was a surprise to the market. It was a surprise meeting, which meant that now all of a sudden we have this demand for oil and the supply went boom down here. And the reason why this is significant, because then you are starting to see gas prices starting to rise again as we're starting to see oil prices rise. And it's unclear how much higher oil prices will go. But if you look at what the economists and experts say, they have, they always have their emotional views. But it looks like oil prices, at least for the near term, are going to be rising. And the reason why that's significant, and we tie this all together now, is because when oil prices and gas prices rise, that affects your cost to go to work, but that also affects the price of things that you buy. Because when you go to the store, you go to Walmart and you want to buy watermelons, it costs money to take that watermelon from the farm, take it to the warehouse, and take it to Walmart. A truck has got to put gas in their truck to ship that watermelon from one place to the other. So when the cost of distributing products goes up, the cost of the actual retail price of the product also has to go up because the cost for businesses rise. So when you see the price of oil rise, the reason why that's so significant is because it has such a strong trickle-down effect into so many different aspects of the economy. And this is where now understanding inflation, where we are right now, and where inflation could go is so important to understand, because right now we are seeing inflation fall. Good news, although we're also seeing the economy get hurt and we have these predictions about where the economy is going, but inflation is falling, which is good news, especially when it comes to the Federal Reserve Bank's fight on inflation. The concern is if things like the housing market and if things like in the oil market to continue to progress the way that they are right now, that could push inflation higher. And this is where the Federal Reserve Bank, who is our central bank here in the United States, who has the decision-making power to decide what are they going to do with interest rates, because higher interest rates are one of the biggest tools that the Federal Reserve Bank has to bring inflation down. They're going to have to now kind of predict and make an estimate on what they want to do to bring this inflation down. If they decide to pause, hypothetically, and they say, we don't want to raise interest rates, and then inflation goes higher, that would make the inflation fight even more difficult, because now you have to work even harder to bring higher inflation down. If the Federal Reserve Bank gets even more aggressive and they say, you know what, we see these red flags in the inflation sector or in the inflation area, and we want to get more aggressive, that's going to cause more pain in the economy. This is where the Federal Reserve Bank is going to be working to figure out what they want to do. And unfortunately, there's costs to higher interest rates and there's costs to lower interest rates. And yeah, it would be better if we avoided the inflation altogether, but the reality is this is where we are right now, and you need to understand these different factors. Now, the reason why higher interest rates are one of the Fed's biggest tools to bring inflation down, they actually have two big tools. One is quantitative tightening and the other is interest rates rising. But let me start by interest rates rising, because I think that's the more pressing and more discussed thing that the Federal Reserve Bank does. The Federal Reserve Bank has the ability to raise or cut interest rates. And the interest rates that they raise or cut are not mortgage rates, they are the federal funds rate. The federal funds rate is the interest rate that the Federal Reserve Bank or that banks charge each other when they lend each other money overnight. So you can think of it like the wholesale price the banks have to pay to borrow money. That is what the Federal Reserve Bank can set. And the Federal Reserve Bank, in order to cool down this high inflation, they want to cool down demand. Because let's go back to supply and demand. When you have more buyers than sellers for anything, whether it's a house, whether it's a car, whether it's avocados, when you have more buyers than sellers, that pushes the price of something up. So now when the Federal Reserve Bank wants to cool down how fast the price of things are rising, they don't want to see the price of things fall. Remember, they're looking for disinflation. They're not looking for deflation. They want to see the price of things rise by around 2%. That does not mean that we're going to go back to pre-pandemic level prices. That means that they want to see the price of things continue to grow, but less quickly than they're growing right now. But in order for things to grow less quickly, they need less people buying things. How do you get people to buy less things? You got to make things more expensive. Now, the Federal Reserve Bank can't go to Best Buy or Whole Foods and say, hey, raise the prices of your stuff. Instead, what they do is they raise the interest rates that banks have to pay. And when banks have to raise interest rates for you, people are less likely to borrow money. I mean, you could think about it like when you go to Macy's to buy a sweater. If that sweater costs $4, you're more likely to buy it than if the sweater costs $400. Because when something's more expensive, less people are likely to buy it. So when it comes to interest rates, it's kind of the same thing. When the Fed raises interest rates and the interest rate on your mortgage goes up or the interest rate on your credit card debt goes up, less people are likely to spend. Less people are likely to go out and buy. If less people are going out and buying a home because mortgage rates are higher, that means you have less buyers. If you have less buyers out there, that means you have less bidding wars. If you have less bidding wars, then sellers are not going to be able to increase the prices of their homes as fast, because when you have 25 people outbidding each other to buy your $400,000 home, your home might sell for $485,000. But when you only have two people trying to bid each other to buy the home, it might only sell for $405,000. So when you have less demand, less buyers, less consumption, the price of things rise less significantly. And this is where the Federal Reserve Bank is trying to operate right now to cool down inflation by raising interest rates. And this is where there's a lot of argument, opinions, debate on what the Federal Reserve Bank should do and how they should do it when it comes to raising interest rates, because it's pretty clear. It doesn't matter who you ask or what type of person you ask. I think everybody agrees that the inflation that we have right now is still way too high. The part where people disagree is how do you bring it down? The Federal Reserve Bank is the main entity here that can help cool down inflation, and the tools that they have is, number one, by raising interest rates. And the other side is people saying, you just got to let it take care of itself. Don't worry about inflation. It will take care of itself. Well, the problem is if you don't take care of itself, if you don't let it do that, and inflation continues to get worse, then that's going to make a much bigger problem, because inflation has a much bigger side effects than, say, a slowing economy, because inflation could cause a currency crisis. It could cause people not valuing the dollar that much anymore. It could cause people to worry about things like hyperinflation. That's a much bigger problem than a recession. We know how to deal with a recession. We've been through that. We go through a recession almost every decade. That's kind of something that we're very used to. It's a part of our economic system. Inflation crises are some things that we are not used to, and those have much more significant impacts, and that could cause much more broad pain, which is why fixing the inflation sooner rather than later is so important. Now, the second tool that the Federal Reserve Bank has to fix or cool down the inflation is through something called quantitative tightening. This one's a little bit more complex to understand, and I think it'll help if you understand quantitative easing first, because quantitative easing is when the Federal Reserve Bank is essentially increasing the amount of money out there. And there's a few ways that the Federal Reserve Bank can do that. Like, the Federal Reserve Bank doesn't just put $1,000 in your bank account. Even when the stimulus checks were going out, that wasn't the Fed sending you checks. That was the government sending you checks. Now, the government doesn't have the money to send out $1,000 checks to people, which is where they then worked with the Federal Reserve Bank. So let's go to the government first, because it'll all tie in together. The government has one source of income. That one source of income is you, me, taxpayers, through tax dollars. That's it. Now, the government, for a long time now, has been spending way more money than what they bring in through tax dollars. This is called the national deficit. And we've been seeing a multi-trillion-dollar national deficit for a long time now, which means that the government generates tax dollars, and then they spend these tax dollars and more through the help of debt. Now, where did they get this debt? Well, they can get this debt from you and me when we loan money to the government through something like a treasury bond or a treasury note. When you do that, you loan money to the government, they pay us back interest. And so now, when the government wants to send out, let's just say $1,000 check, they don't have the money to do that. So what do? Well, then they can issue more treasury loans that people can make. But there's not enough money or people that are going to be loaning money to the government to fund all of these checks, which is where the government will then work with the Federal Reserve Bank. So let's just say the government issues $1 trillion worth of treasury loans, and they call up the Fed and they say, hey, we want to do this thing. We want to send out stimulus checks, or we want to do this program. We want to build bridges. We want to do whatever we want to do. The government wants to spend money on something, but they don't have the money to do so. They can then call the Federal Reserve Bank, who has the ability to print that $1 trillion or whatever it might be, and then they loan that money to the government. The way they do that is by buying these bonds. And so they print the money, buy the bonds, aka loan the money to the government. The government has the money, and then they can do whatever they want, whether it's send out stimulus checks, whether it's build bridges, whether it's hire more military people. The government can do whatever they want. Now, this is all good until it's not good. Because if the government could spend an unlimited amount of money, the question is, why do we have to pay taxes in the first place? I mean, if the government can work with the Fed to print an unlimited amount of money, why do we have to go to work to pay taxes? And this is where the reason why is because there is a cost to the government spending too much money. And by spending too much money, I mean the Fed having to print money to subsidize the government. And that cost is inflation. Because inflation comes from the word inflate, which is when you increase the monetary supply. So when you increase the monetary supply, the value of each individual dollar goes down, in effect causing the price of things to go up because the currency that you're using to buy that thing has less buying power. That's what inflation is. And so over the last number of years, especially post-pandemic, the Federal Reserve Bank has grown their balance sheet, aka grown the amount of money that they've printed very significantly. And the things that they bought include treasury bonds, loans to the government, and they also buy mortgage-backed securities. And so mortgage-backed securities are essentially loans to fund the mortgage market because it's a way to help provide security and liquidity to banks, because now when a bank issues a mortgage, if a bank issues a $500,000 mortgage to you, a 30-year fixed rate mortgage, if the bank had to hold on to that $500,000 mortgage, they're not going to get that money back for 30 years, which means that if somebody else comes to them for a loan, they might not have the money because all their money is already lent out. So this is where banks want to be able to liquidate and get out of these loans, aka sell these loans. That way they can continue making more loans. And so who can buy these loans? Well, regular people can buy these loans, but then also you have the Federal Reserve Bank that can continue buying these loans to encourage the mortgage market, to encourage people to lend and borrow. So the Federal Reserve Bank has been a huge buyer of mortgage-backed securities and treasury bonds. And during the pandemic, they also bought corporate bond funds, but let's just ignore that for now. So the big things that the Federal Reserve Bank has been buying are treasury bonds and mortgage-backed securities, which is how they built up this big balance sheet. And that was quantitative easing. Now, the second thing that the Federal Reserve Bank can do is quantitative tightening. Quantitative tightening is doing the opposite of the quantitative easing. Quantitative easing was buying up these treasury bonds and mortgage-backed securities. Quantitative tightening is selling these treasury bonds and mortgage-backed securities. Now, the reason why this is significant is because it helps relieve part of the Federal Reserve Bank's balance, because now they've printed this money and now they're trying to get rid of those assets by having private buyers go out and then buy some of these bonds off of the Federal Reserve Bank. The downfall is, well, when you have a big seller of anything, let's just say you have everybody trying to sell their home. Well, then that would push home prices lower because now you're increasing supply. And that's kind of what you see happen here. And the Federal Reserve Bank is doing this slowly for this very reason, because now when the Federal Reserve Bank has to sell off their treasury bonds, that means you're increasing the supply of treasury bonds. When you increase the supply of treasury bonds, that pulls treasury bond prices lower. And remember, a treasury bond is a loan to the government. The way that you get paid back is through interest. And the interest rate on these treasury bonds are inversely correlated to the price of the bond. I know this is very confusing. Just stick with me for another 60 seconds and it all makes sense. So if the Federal Reserve Bank is now selling off these treasury bonds, and then you see the price of these treasury bonds go down, that means the yields or the interest rates on these bonds go up. And who pays these bonds? The government. So that means that if the Federal Reserve Bank is working to sell off their bonds, interest rates go up, which means that the government's interest payments would also rise. Now, this is where it all starts to tie together with inflation, because now when the government has high interest payments that they need to make, that can be difficult because how do they make these interest payments? Through tax dollars. Where do they then generate these tax dollars? Through people like you and through people like me. So the government is working to generate tax dollars, and now what we're seeing happen is a bigger and bigger piece of the government's expenses is just interest. They're working now to generate tax dollars, not to invest in more infrastructure, not to give back to the community, but just to pay back their previous expenses. Right now, the estimation is that in the next few years, forgot the exact year, but it was like the next few years, the government interest expense is going to exceed the total military budget. Why? Because not only is our national debt rising, but the interest rates on this debt that the government has to pay, because it's not a 30-year fixed rate mortgage, it readjusts, the interest rate that the government will have to pay on these debts is also rising. So we're seeing the government's costs rise, and the way that they pay for these costs is through taxpayers. Now, this is where we can start to see why the economy becomes so important, the second part of this video, because now when you have a growing economy, you have people making more money, businesses making more money, which generates to higher tax dollars for the government. But we're seeing different things happen in the economy. Like the Federal Reserve Bank said that they're predicting now a recession in the end of 2023. Now, I know for the average American, they're already in a recession, but it's expected to get worse. And this is where now, if people's incomes go down, or if people lose their jobs, or if business profits go down, that would also equate to less tax dollars for the government. And you can start to see why that's so significant, because now you have this inflation problem. You have people that are worried about the strength of the dollar. That's what inflation is. And then the government's ability to pay for this debt also becomes threatened when they're not generating enough tax dollars, which is why some people have proposed we can print money to pay down our interest. And you can start to see why that would be such a big problem. But this brings me to the economy. Our economy is facing a unique challenge because we have three different factors coming together at the exact same time. On one end, we have high inflation, which is slowing down the economy. Second, we have the higher interest rates, which are also slowing down the economy. And then the Federal Reserve Bank, in their most recent meeting minutes, announced that they believe that we will enter a recession by the second half of this year. Now, I'm going to go over the Federal Reserve Bank's meeting minutes, especially when I talk about the economy in this video. Now, I've already gone through the Federal Reserve Bank's meeting minutes and read through it and analyzed it. But if you want to read it for yourself, which I highly encourage you to do, that way you can make your own assumptions, because you never want to blindly trust or listen to a random guy on YouTube. I will also link those Federal Reserve Bank meeting minutes for you down in the description. But the reason why high inflation slows down the economy is because our economy runs on spending. The more money you spend, the more money somebody else makes. This is why our economic system is the way it is. Now, if you think about that, that means if you're broke and drowning in debt, it's not good for you, but it's good for the economic system, because if you spend more money at Chipotle, if you spend more money at Gucci, and you had to go into debt to do that, that means you spent more money at these places, and Chipotle and Gucci made more money. That's why high inflation hurts the economy, because when the price of things have to rise and people's incomes don't rise fast enough to meet the high inflation, which is what we've been seeing happen, that means people have less spending ability, because now more of your money is going to your rent, more of your money is going to your food, and you have less money to go out and travel, less money to go out and buy discretionary items, which means businesses get less sales. That's not good for the economy. So high inflation is slowing the economy. The second thing is the higher interest rates. Now, the higher interest rates are a little bit easier to understand because, for one, they influence spending. When mortgage rates go up, less people are interested in buying a home because that home is less affordable. If mortgage rates jumped up to 10% tomorrow, you bet that the demand to buy a home would fall, which would push home prices lower. If mortgage rates fell to 2% tomorrow, you bet that more people want to go out and buy a home, which would push home prices higher. So now we have higher interest rates today than we did 6 months ago. And when I talk about interest rates, I mean the interest rate that the Federal Reserve Bank sets. And these higher interest rates have an impact on the economy. The housing market is easy to understand, but it impacts every single aspect of the economy. The most notable example of this was just looking at what happened with Silicon Valley Bank. They collapsed because of higher interest rates. Silicon Valley Bank owned a lot of treasury loans, treasury bonds, loans to the government. And as interest rates went up, the value of these bonds went down, which meant the Silicon Valley Bank was sitting on a lot of underwater assets. And then you saw the bank run happen, and they were not able to raise more money, and then they ultimately collapsed. So higher interest rates impact many different aspects of the economy, not just home buying, not just banks, but every aspect of the economy, because higher interest rates make the cost of doing business more expensive. And all three of these things then lead us to the economic slowdown, which is why now the Federal Reserve Bank is predicting a recession by the end of 2023. Now, again, this is just semantics. The average American is already in a recession, but the Federal Reserve Bank is now predicting that we will be in a defined actual recession by the end of 2023. And they gave a few reasons for this. And let me start by talking about what the Federal Reserve Bank had to say about the banking sector and how that is going to lead to a recession for the United States. This is directly from the Fed's minutes. They said, Given our assessment of the potential economic effects of the recent banking sector developments, the staff's projection at the time of the March meeting included a mild recession starting later this year with a recovery over the subsequent 2 years. Meaning, because of what's happening in the banking sector, the Federal Reserve Bank is expecting that we will enter a recession by the end of 2023, and then we're going to spend 2024 and 2025 then recovering from this recession. And what is the cause of this recession according to the Federal Reserve Bank? Well, the first domino, which is the banking crisis. And the reason why the banking crisis, according to the Fed, is going to cause this type of recession, this economic pain, is because of the credit crunch caused by the banking collapse. Now, again, we did a full deep dive of this in Market Briefs, my free financial newsletter. If you have not joined Market Briefs yet, I highly recommend you do so because it's free and it's an easy way for you to stay up to date on what's happening in the financial markets. And I got the link to how you can join Market Briefs down in the description below. But this is where now the reason why the banking crisis is causing a credit crunch is because, well, less banks are likely to lend because of what's happening. Banks have to become more cautious. They have to become more safe. And when they're becoming more cautious and more safe, they're lending less money. The reason why that's important is because, again, our economic system runs on spending. And so if banks are lending less money, that means you have less money to go out and buy things with. Now, this could be you wanting to buy a home, it could be you wanting to buy a car, or it could be you as a business who wants to invest in more manufacturing, or you as a business who wants to open a new plant or a new headquarters or wants to expand your operations. And so when less lending is happening, less money is entering our economic system, which means less spending is happening. And if less spending is happening, well, you get it. That will slow down the economy. This is why the Federal Reserve Bank is now stating that they predict that we will enter a recession by the end of 2023. The second thing that the Federal Reserve Bank talked about when it came to this slowdown in the economy had to do with our economic growth and inflation. Let me read you what they said. They said, with inflation remaining unacceptably high, participants expected that a period of below-trend growth in real GDP would be needed to bring aggregate demand into better balance with aggregate supply and thereby reducing inflationary pressures. What that means is right now we still have the stubbornly high inflation. Yes, inflation has come off of its high, but it's still extremely high. And this is where the Federal Reserve Bank is working to raise interest rates to bring inflation down. But in order to bring inflation down, they need to cool down demand. How do they cool down demand? By raising interest rates. Why does that cool down demand? Because higher interest rates make it more expensive for you to buy things. That will then make spending slower because less people buy homes, less people buy cars, less businesses go out and invest because the cost of borrowing is higher, which would then lead to lower spending, which would then lead to a slowdown in the GDP, our economy. And this is where the Federal Reserve Bank is saying that a below-trend growth in real GDP would be needed, that it is needed to slow down the growth of our economy in order to cool down inflation. And it's interesting because on one hand, the high inflation is already hurting our economic growth. Why is the high inflation hurting our economic growth? Because again, when you have this high inflation, people don't have the ability to go out and buy things the way that they could before. So high inflation is hurting the economic growth, and this is where now the Fed is saying that we need to slow down our economic growth even more. That way we can cool down the inflation. How do they do that? By raising interest rates. And this is where the Federal Reserve Bank is saying that there is going to be impacts of this, and we still have to continue raising interest rates. This was a big question mark after the Silicon Valley Bank crisis, because when that bank crisis happened, a lot of people were unsure on what was going to happen. First, it was that FDIC insurance would only protect you up to $250,000, but then we saw Janet Yellen and the FDIC and the Federal Reserve Bank come together, and they essentially said that we will insure your deposits up to infinity. Now, there's still a lot of uncertainty about what that actually means and what that will look like if we have more bank failures in the future. And a lot of people do believe that we will see more bank failures. Even Warren Buffett recently come out and said that we will see more bank failures. But it looks like there's at least some sort of commitment by the FDIC to continue to protect depositors, meaning people who save their money in a bank. And after this all happened, there was a lot of uncertainty. And even the Federal Reserve Bank talked about this, where they were unsure whether they should continue raising interest rates aggressively or even at all because of the bank failures. Here's what the Fed had to say. Some participants noted that given persistently high inflation and the strength of the recent economic data, they would have considered a 50 basis point increase in the interest rate. But because of what's going on in the banking sector, that has caused the Federal Reserve Bank to not do that. In other words, the Federal Reserve Bank said that they were thinking about raising interest rates by 0.5% because of how strong inflation was. But then because of what happened in the banking sector, they decided to do it by 0.25%. And you can bet that they were debating about whether they should even increase interest rates at all. And so this is where now you start putting it all together. We have some issues in the banking sector, but now we've kind of had this Band-Aid put on top of it. The government and the FDIC have come together and they said, we're going to put this Band-Aid on the banking sector so it doesn't continue bleeding because we're going to insure the depositors. Now, of course, there's a cost to insuring depositors, and that cost will be either if FDIC has to pay out more money, that is inflation, because FDIC doesn't have enough money to insure all depositors, and the FDIC is backed by the full faith and credit of the United States government. So if you see more banking failures and FDIC has to pay out bigger deposits, that will be paid by the government. But then you also have the government saying that the additional deposits will be paid out by private banks, by fees to the banks. Well, how do private banks get their money? They get their money by charging you and me and regular people service fees, which means that if banks have to pay higher costs, then that's ultimately going to be trickled down to you. So there's a cost to everything, but I think we've pretty much established that no matter what happens, there's going to be a cost to it. Now, when it comes back to the idea of the slowing economy, this is where now, understanding what's happening, we are still in a place where, unemployment is very strong. Unemployment is very low. We have a lot of people that have jobs, although they might not have the jobs that they want, or they might not feel like they're getting paid enough. The reality is people still have jobs. But one of the factors that the Federal Reserve Bank is working on, or what they say is going to be a byproduct of this reducing demand, the slowdown in GDP, is going to be higher unemployment. Right now, our unemployment is right around 3.5%. And they're expecting unemployment to go up to 4.5% by the end of 2023, which means if you just do the math, that's about 2 million Americans would have to lose their job between now and the end of the year in order to bring us to the unemployment level where the Federal Reserve Bank thinks that we're going to be. Now, you can either think that the Federal Reserve Bank is being very conservative or they're being very aggressive. But just remember, the Federal Reserve Bank doesn't want to panic people. They historically have said the most optimistic views, because if the Federal Reserve Bank is saying more negative views, that people would panic and that would cause more havoc. That's why the Federal Reserve Bank kept saying, we're not going to see any inflation. What are you talking about? How could we see high inflation from printing trillions of dollars? Then they said that the inflation was transitory. Then they said, don't worry, we got it under control. And then when inflation hit 9%, they said that we have to get aggressive to bring inflation down. So right now we have the Federal Reserve Bank who is saying that unemployment is going to go up to around 4.5%, and that they expect about 2 million Americans to lose their jobs to get the unemployment number there. Why do they want to see the softening in the labor market? Well, it's not that they want to see people lose their jobs, it's that they want to see inflation come down. And one of the byproducts of raising interest rates to bring inflation down is that you see this cooling in the economy, aka businesses have to reduce, and that means the people have to lose their jobs. Now, if it's worse than that, then that means even more people would lose their jobs, more businesses go under. And now, this is where I want you to understand, this is what the Federal Reserve Bank is saying. What can you do about it? Number one is get the emotion out of the equation. You have a lot of people here and on the internet, and I understand YouTube is a big play in this. There's a lot of emotion in the financial markets. And the reality is, in the media game on the internet, if you don't have, let's just say, an attractive title, nobody clicks on it. Okay? I understand that. And that's why we have to use some of the titles that we use. But do not follow a title. Now, one of the things that I try to do is provide education in the videos. That way you can get a better understanding of what's happening instead of just being led down an emotional roller coaster of what might be happening in the financial markets. But this is where, that's also why I created market briefs, because you don't have to worry about the sensationalism. You get one email and the email breaks down everything you need to know. That way we don't have to go into that whole clickbaity game. That's why I'm so trying to grow market briefs instead of trying to give the education through this traditional media game. But back to the focus of this video, there is a lot of craziness out there. There's a lot of emotion out there. And what I want you to understand now as a financially savvy person is that some people will get hurt because of this economic slowdown. And what I want you to do is not be one of those people who gets hurt. Instead, I want you to be one of the people that understands this and can actually capitalize on the opportunities. And the way that you can do that is by, number one, getting the emotion out and rather cut through the noise and read the actual data, read the actual information, and then look for opportunities. The way you look for opportunities is by, number one, understanding where the opportunities might be. And these are not by going out and buying things, but rather by buying investments. Here's the reality. Recessions and market crashes create more millionaires than any other time. Why? Because recessions and market crashes cause the price of good assets to go on sale. Why? Because when you see market crashes and recessions, people panic and they sell. Why? Because when you see recessions and market crashes, you see bad assets fail. Why? Because when you see recessions and market crashes, people don't have the ability to spend, and that's when the tide goes out. People don't have the same access to money, and the dumb and bad businesses fail. That's why the saying is, when the tide goes out, you see who's been swimming naked. When the party ends and the lights turn on, you see who's been partying a little bit too hard. And so now, when the money starts to fade away, and you start to see the bad investments get exposed, people will get worried. Either people will get worried about what's going on with their investments. It might be a good investment or bad investment, which could cause people to sell. People might panic and they might sell, or people will need money and they will sell. This is what has happened for decades. This is not me predicting what could happen in the future. This is me telling you what has happened decade after decade after decade after decade. It's the same thing. That's why I always say history doesn't repeat itself, but it does rhyme. So that is what has happened in the past. And so now, if you can find an opportunity, whether it's in a stock, whether it is in a real estate opportunity, whether it is starting a business, whether it's investing in a business idea, whether it's an alternative investment, if you can find an opportunity, well, now, if you are prepared, you can go out and actually take advantage of the opportunity. Now, how do you get prepared? Number one is by investing in your financial education. Clearly, you are doing that by watching this video. But reading books, watching videos, potentially investing money into learning more. That is investing in your financial education so you can learn how to do things like analyzing a stock, analyzing a real estate investment, making a real estate investment, going out and starting a business, or investing in startup companies. You can learn how to do that by paying money, reading books, or by watching YouTube videos. Then the next way that you're prepared is by putting aside cash. Because the reality is when these opportunities come, you have to have money to be able to take advantage of these opportunities. And if you're worried about how you're going to pay your bills because you lost your job or because something's going on in the economy, you can't take advantage of opportunities because you're worried about how you're going to put food on the table. And so preparing also means now being financially smart when times are okay. 2023 is not the year to go out and finance a new truck, period. 2023 is the year for you to now start building your financial savviness, putting some cash aside to protect you against an emergency, putting cash aside to take advantage of opportunities that might come your way, and putting money aside to start investing and learning about investing, because there's a lot of different investing strategies. You can be a passive investor, which I do. You can also be an active investor, which I also do. Passive investing is where you don't worry about what's happening in the market or the economy. You just keep putting your money into this asset, into this thing, no matter what happens. So I personally, and I'm not telling you what to do, investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money, which is why you should always do your own due diligence and never blindly trust a random guy on YouTube. I'm just telling you what I do to tell you what I do. I passively invest my money in three places. I passively invest my money into the stock market. I passively invest my money to buy physical gold. And I passively invest my money to buy some cryptocurrency. Now, in the stock market, I have a system where every Wednesday money leaves my checking account and is automatically invested into my portfolio of ETFs. These are funds that give me exposure to a basket of companies. Some of these are value ETFs. Some of these are dividend-paying ETFs. In fact, most of these are dividend-paying ETFs. Some of these are emerging markets. These are countries and companies that are overseas. Some of these are more of the innovation and risk asset type of ETFs. So every Wednesday, does not matter whether the market's up or down, my system keeps pulling cash out and it keeps investing into these things, and it happens no matter what. If you see a market crash, you don't change it. The only change that I would make is potentially buy more. When the market's booming, you don't change it. It's this passive, consistent, and automatic. With cryptocurrency, it's similar, except now it's daily. I believe in the long-term value of crypto, but I also understand that it's extremely volatile. I understand that it's extremely speculative. I understand that it can go down to zero. But I have a system where I'm buying some cryptocurrencies, some of the bigger coins, every day. And it's not a ton of money. It's a very small piece of my portfolio, but I accumulate that because I believe that cryptocurrency and the blockchain will have more value in the future. Now, can it go down to zero? Sure. If it did, would I be affected? Not really. It's a small piece of my portfolio, and I understand that. The third thing is I buy physical gold. Now, again, I buy physical gold passively, and I buy it every month. And I'm not talking about buying gold ETFs or gold paper certificates. I'm buying the actual physical gold. There are platforms on the internet that can do that for you and that can automate the process. That's just what I do. Now, again, do not copy what I do. I do not recommend what I do to anybody because you have a different time horizon. You have a different risk tolerance. You have a different goal than I do, and you have a different investment criteria. I like cash flow. Most of my investments are cash flow producing. You might hate cash flow. Some people don't like investing for cash flow because you got to pay taxes on the cash flow. I like cash flow. So don't do what I do, but rather learn. And this is where now, what is your investment criteria? What's your investment portfolio, and how do you learn how to invest? These are my passive investments. I also have active investments. Number one, I actively invest back into my own business. I talked about Briefs Media. Market Briefs is one of the newsletters that we have in Briefs Media, and I'm actively working to help grow that newsletter. The second place where I actively invest my money is into real estate. Outside of my own business, real estate is probably my favorite place to invest money because I like owning a hard asset, and again, it creates cash flow. Third, I actively invest into stocks, individual companies. I passively invest into the funds, but if I find an individual company that I want to invest in and that I find is a good opportunity, I will then go out and buy. Then I also have active investments into startups. I recently started doing this in the last few years, around the time when the pandemic started. And I like it because I've been very fortunate to build up a platform here where I can also help promote and grow companies that I believe in or that I'm a part of. And then secondly, because I like working with entrepreneurs. I am an entrepreneur myself. And so it's kind of cool and fun for me to be able to invest in and help other entrepreneurs. But it's risky. The statistics say that something like 8 or 9 out of 10 startups will fail within the first 5 years. Meaning statistically, most of the companies, almost every single one of the companies I invest in will fail, go down to zero. And startup investing is a little bit more interesting because you can't get your cash out the way you can with a stock or a real estate investment because you can just sell those. With a startup, you're kind of just waiting to see if the startup will get acquired or if it will go public. And if neither of those two things happen, you will never see your money again. Now, there's platforms on the internet which make this type of startup investing so much more accessible. These are called crowd-funded investments. But it's a small piece of my investment portfolio. It's something that I enjoy. It's something that I believe in, which is why I invest my money there. So now, based off of that, again, I don't recommend what I do to anybody, but you can now do your own research and find the right opportunity for you. What are the ways that you want to invest? Do you want to be a passive investor? Do you want to be an active investor? Do you want to do both? The big thing is you got to just do something. Yes, you will lose money at some point. Losing money is a part of the process, but you got to just get started. And for me, I started off as an active investor. I liked investing. It's something that's enjoyable to me. I like finance. I know I'm a nerd, but these are things that I enjoy. If you enjoy it, then maybe you could start off as an active investor. If you don't want to spend the time and effort and energy and research doing that, then you can be a passive investor. But the key is you just got to get started because now the reality is we have all these red flags in the economy. Now, you can either sit there and do nothing or you can prepare. And the nice thing is, if you prepare and nothing bad happens, well, you're just in a better financial situation than you were before. You have extra cash put aside. But if you prepare and something bad happens, now not only can you be protected, but you can take advantage of opportunities to come your way. And this is where so many people end up getting hurt, because the reality is every decade or so, we go through some sort of economic slowdown or market crash. We saw it happen in 2020. We saw it happen in 2008. We saw it happen in the year 2000 with the dot-com bubble bursting. And do you know what's interesting? After the 2008 crash, do you want to know the longest period in the history of modern America, the longest period that our economy has ever gone without a recession? Well, it was after the 2008 crash. And that was almost a forced recession, because when the pandemic hit, our economy was shut down. So obviously we'd go into recession because nobody's making money, nobody's doing anything. But if it wasn't for, even with that, that was the longest period from the 2008 bottom to the 2020 pandemic. That was the longest period that our country has ever gone without an economic slowdown. So now, when you understand that, you understand the history rhymes, you understand that, hey, we have some red flags in the economy. We have interest rates that are rising. We have inflation that is still high. Now the Federal Reserve Bank is saying that we are expecting a recession by the end of 2023. What can you do about it? You can ignore it and say, oh, everything is fine. You can panic and say, oh my God, why has it not happened right now? Or you can start preparing, because the reality is nobody can perfectly predict or time the market. While the Fed says this is going to happen by the end of 2023, it might not. But we still have the red flags. And it might take longer than expected. Or it might be shorter than expected. There's still a lot of money out there. JP Morgan's latest statement and their annual report said that there's like $1.2 trillion of excess money since the beginning of the pandemic still floating around out there in people's bank accounts. So maybe it will take longer than expected. Maybe it won't. Maybe it won't ever happen. Maybe it will. But the reality is we have these red flags out there, and this is what you want to be paying attention to. That way you can prepare and take care of yourself. And now that we understand what's going on in the economy, this brings me to the topic of the dollar, because we've been seeing a lot of interesting things happen. Our economy here in the United States depends on the dollar. It's the lifeblood of our currency, but we've been seeing a lot of interesting things happen where countries around the world are trying to move kind of away from the dollar. Our United States dollar is facing one of its biggest challenge ever because of something called de-dollarization. And what de-dollarization is we're seeing big countries around the world essentially pull away from the dollar. And the reason why that's so significant is because the United States dollar is the world's reserve currency, and we're kind of like the world's superpower, and that gives us a lot of ability. One of that ability is the ability to essentially print money, because countries around the world want to save their money in dollars. And people around the world also want to own and save dollars. And now as we're seeing these big countries start to pull away from the dollar, it shows that you have a lot of powers around the world that don't like being controlled by the United States. They don't like being bullied by the dollar, and they want to pull away from that. And the reason why that matters is because if we continue to see more of this de-dollarization happen, it can reduce the value of the dollar. And if you see the value of the dollar drop, well, the currency that we use to conduct and transact everything would lose value. And that would make the inflation problem significantly worse. Right now, the reason why we have high inflation is because we printed a lot of money over the last few years. But you got to remember, we printed a lot of money, but the reason we were able to do so was because we have the power as the world's reserve currency and as the world's superpower country. And if we start to get that challenged and people start to not value the dollar so much, and the dollar starts to lose its value, not only would we potentially lose some of the ability to print as much money, but we also lose some of the value of the currency that we have right now, which would make the inflation problem significantly worse. And we know how to deal with economic pain. Like, we've had recessions many, many times in the last century. We know how to deal with a recession. But dealing with a currency crisis or a dollar crisis is much more painful and much more significant, which is why this dollar de-dollarization is such a big concern. And this really started back in 2022. That was when the first real step of the dollar de-dollarization started, because when Russia invaded Ukraine and started attacking Ukraine, that was when the United States put a freeze on Russia's assets. So the United States froze hundreds of billions of dollars, US dollars, of Russia's assets, their money that we froze because we wanted to sanction Russia. We, the United States, did not like what Russia was doing, so we froze your currency. And this put up a lot of red flags for countries around the world because, there's a lot of countries in the world that don't like the United States. But when they saw that, it really created a big red flag because they saw that if they do something, this other country in the world does something that the United States does not like, then the United States might freeze their money. And that created some concerns around the world, or really, let's say, amplified these concerns, because these concerns have been around forever, but those concerns really amplified when we saw Russia's assets get frozen by the United States. And we saw countries start to take action on that. The second thing that happened was then later that year in 2022, China went to Saudi Arabia and they said that we want you to sell us oil, not in the dollar, but in our currency, the yuan. And the reason why this matters is you might have heard of this term called the petrodollar. And the petrodollar essentially means that while the United States dollar isn't backed by physical metals, it's not backed by physical gold, it's not backed by silver, it's not even backed by oil, it's backed by the full faith and credit of the United States government. We are the strongest government in the world. We have the strongest military presence in the world. We have the strongest economy in the world. Plus, countries around the world have to transact with dollars. And one of the commodities that everybody in the world needs and uses is oil. And if you wanted to buy oil, you had to use the dollar. This provided strength to the dollar because it guaranteed that if you wanted to make a transaction in oil, you had to use our currency. Even if you are, let's just say China, who doesn't use the dollar, and you wanted to transact with a different country which didn't use the dollar, you would have to transact with the dollar to buy oil, which provides reassurance and stability and security to the dollar, because if anybody in the world, and a lot of people or everybody in the world needs oil, well, you have to use a dollar to get it. So that provides stability and strength to the dollar. Then China went to Saudi Arabia and said, you know what? We're tired of this petrodollar system. We want to be able to buy oil in our own native currency, the yuan. And that's what started to happen. For the first time in, modern history, we saw transactions occur with oil, not with the dollar, but with a different currency. Now, again, that poses a big threat to the dollar because now that means that countries can make transactions with a currency that's not the dollar when it comes to oil, which hurts the power and the strength of the dollar. The third thing that happened kind of around the same time is we saw the BRICS nations, Brazil, Russia, India, China, and South Africa come together and say that first we want to create a new currency. We don't want to continue being bullied by the United States. We don't want to continue being under the rule of the dollar. We want to work together to create our own reserve currency. That way we can transact with whoever we want with our own currency and not have to go through the dollar. And then the second thing was that they want this new currency to be backed by precious metals like physical gold. Now, again, we covered this entire BRICS story in Market Briefs, which is why, again, if you have not joined Market Briefs, I highly recommend you do so. It's a completely free way for you to stay up to date on what's happening in the top financial news into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join for free down in the description below. But this is where now we have the BRICS nations that came together that said we want to create a new currency, and then they wanted to be backed by precious metals like physical gold. And then what we saw happen was we saw central banks around the world buy more physical gold than we have seen in 5 decades. Tons and tons and tons, literally tons, like physical tons of gold were acquired in the last 12 months as these central banks want to create a new currency with more stability, that's safer, that's backed by precious metals. And then the fourth thing that happened, and this is much more recent now, is we saw now countries who trade in the dollar make agreements outside of the United States to say we're no longer going to trade with the dollar. The most notable example of this was the Brazil and China agreement. This happened recently in 2023, where Brazil and China came together and said that we're going to ditch the dollar. Neither of them have the dollar as their currency. They both have their own native currencies, but before this agreement, they had to trade with the dollar, meaning that if they wanted to buy something in their respective country, they had to convert their currency to the dollar and then use that dollar to buy the item, and then the other country would have that dollar or currency then. But now this new agreement says that Brazil and China will be able to trade with each other with their own respective currencies, which means, again, they're ditching the dollar and don't have to use the dollar to make the transactions. What does that do? It reduces the strength of the dollar in that instance because, again, less people have to use the dollar in order to transact. And the value of a dollar isn't physical gold. It isn't silver. It's backed by a promise. It's backed by the promise that the United States government believes that we have value in that dollar. And if people don't believe that the dollar has value, then the currency begins to lose value. So it started with the petrodollar started to lose its potential value. Now we have Brazil and China doing the same thing in their own respective trades. And then we have our own issues here in the economy with the dollar health. The first issue here is naturally the national debt that we have. We have more than $31 trillion worth of national debt. And coupled with that, we also have extremely high inflation. So now think about this from the perspective of an investor. If you're a foreign country and you want to save your money and you want to put it somewhere safe, you want to put your money to the safest thing possible, which has been the United States dollar. But again, if you see high inflation, that means that the value of the dollar is dropping. And if you see high inflation with high national debt, that can be very concerning. And so now you have countries around the world that are looking at this saying, yeah, we like the dollar. It's the safest place to put our money. You are the world's strongest economy, the world's strongest military, but you have all this national debt. Can't that be a problem? I mean, isn't it going to be a problem for you to be able to make the payments on this debt? Because if you can't make the payments on this debt and you default, the value of the dollar will plummet. And we don't want to be in that situation when that happens, not to mention the fact that you also still have such high inflation. Yeah, it's come down off its highs, but it's still extremely high, which means that our savings, our dollars, are losing value. That's a risk. And then more recently, we have the issues with our banking sector and the economy. And yeah, we've seen the credit crunch after the Silicon Valley Bank collapse, but we also have the worries about an economic slowdown and the recession, which has people worried and wondering what's going to happen to the health of the dollar. What's going to happen to the United States economy? Because if we see the economy go down and the value of the dollar go down, that makes saving your money in the dollar, especially when you are a foreign country that wants to protect the health of your investments, it makes it a little bit more risky for them. And that's why we've been seeing now a lot of this de-dollarization. And it started off kind of as a conspiracy theory. And I would say until about late 2022, that conspiracy theory turned into like, oh crap, this might be a real thing. And now, again, take this with a grain of salt. Take it with a bit of caution, because the reality is there's a lot of emotion out there. There's a lot of people that spew fear. There's a lot of people that spew panic, but no good financial decision ever comes from panic. No good financial decision ever comes from fear. No good financial decision ever comes from greed. This is where I want you to understand what's happening. That way you can make better decisions for yourself. Look, today, the dollar is still the world's reserve currency. The dollar today is still the strongest currency in the world. The dollar today is still a part of the strongest country in the world. That is where we are right now. Are there risks? Absolutely. I think the best resource that I can give you for this is a book by Ray Dalio. Ray Dalio is the founder of Bridgewater, which is the largest hedge fund in the world. And he wrote a book called The Principles for the Changing World Order. And by world order, he means the world's reserve currency and the world's superpower. And what he discusses is that everything, people, businesses, and countries have a lifespan. And that lifespan follows a similar curve no matter which century you're in. And part of that curve is the debasing of your currency, meaning the value of your currency going down because you print money. Why do these countries print money? Because you want to continue growing the economy, and then you start to have a lot of obligations. People want better lives. People need better jobs. People need more money. So the government just keeps printing and printing and printing. And then they start providing aid to other countries around the world. And you keep printing and printing and printing. And eventually people start to lose faith in that currency. People start to lose faith in that thing that you have, which then causes the value of that thing to go down, which then creates opportunities for other countries and currencies around the world to then take a leap forward. I would recommend you read that book. That book has a ton of value and education in there. But this is where now understanding, okay, if all these things are happening in the world right now, what can I do? Now, for one, it's like I always say, be prepared and financially educated. But you can make investments that help protect you, because if the value of the dollar goes down, that means your cash value goes down. And that also happens when you have high inflation. Now, this doesn't mean you shouldn't have any cash, but just understand that when you have inflation or the value of the dollar dropping, that hurts the value of dollars. So where can you put that money? Well, I own some physical gold, and I can't tell you what to do. I do not recommend anything that I do for anybody. I'm just telling you what I do, and then you can figure out what it is that you want to do for yourself, because the reality is investing has risks, and you want to always do your own due diligence. Never blindly trust a random guy on YouTube. But this is where now I own a little bit of gold. It's about 2% of my total investment portfolio. Is it a huge chunk? No. It's my insurance. It's a hedge. I don't look at my gold investment like it's an investment. In fact, I look at it like an alternative way to save money. It's a way for me to save hard money. I've been buying gold for, a long time now. I buy a little bit of gold every month, and it just sits there. It doesn't do anything. It doesn't provide any value. I don't really even monitor the price of gold. Whatever happens to the price of gold happens. I don't really care. It's just an alternative way for me to save money. And the reason why I buy gold is because the way that I look at it is, if I was to save $50,000 of cash, and I saved $50,000 worth of gold today, and I buried both of these in my backyard today, and then 10 years from now, I go to my backyard and I dig up the gold and I dig up the cash, which one of these will have more buying power? My theory is that the physical gold is going to have more buying power than the cash. And so that's why I own a little bit of gold as an insurance, as a protection, as the hedge. And other people look at cryptocurrency as another hedge. Now, again, I don't recommend this to anybody, but cryptocurrency is very risky. I own crypto, but it's very risky. It's very speculative. It's very volatile. It can go down to zero. And so now, if you're going to be investing in cryptocurrency, understand the risks, understand that it can go up very quickly and it can go down just as quickly. And if you're not willing to accept that risk and that potential of going to zero, do not buy cryptocurrency. If you can't invest in it as a long-term investment and don't believe that it will grow, do not buy cryptocurrency, and never invest more than you're willing to lose. So with cryptocurrency, yes, it can grow very quickly, but it can fall just as fast. So understand that risk and understand that it's very speculative, and yes, it can go down to zero as well. Another thing is looking for hard assets, things like physical real estate. I own physical real estate. That can be an opportunity for you to own something that has tangible value, because let's just say worst case scenario right now when the dollar goes down to zero, which isn't that likely, because guess what? The United States still has a strong military presence and a very strong economy. But let's just keep going with the worst case scenario. If the dollar no longer exists and you own real estate, well, now you could change your rent from $1,000 a month to 2 chickens a month, or 10 eggs a month, or whatever it is that you want, because you own that value producing asset. So real estate provides some value there. You can also diversify some of your potential stock holdings to emerging markets or countries that are not reliant on the dollar. There are ETFs and funds that give you exposure to international economies, international companies, international real estate, emerging markets. Is something for you to consider. It's more risky because now these other countries might be smaller. They might not have as strong of a military presence. They might not have as much law and order. They might not have the same infrastructure that the United States has. But it's something that you can consider as another form of diversification. And you can work to increase the value that you can provide. How can you provide more value that way you could earn more money? How can you provide a value that can be applied worldwide? How can you create a better skill set for yourself? That way you can continue to provide more value, because at the end of the day, even if a company relies on a dollar, the company is still providing value. So if the currency changes, they can still continue to provide value. Now, of course, if the dollar continues to lose value, that hurts companies. That hurts things. But understanding the importance of investing in value things and how you can do that. Now, again, there's a lot of ways that you can invest your money. Stocks, real estate, crypto, businesses, your own business idea, your own education. There's an unlimited number of things that you can invest your money in. But the key here is to get started with something, at least start investing. I mean, I think that's the most important thing, not to be worried so much about the dollar, not to be worried so much about the economy, not to be worried so much about inflation, but use this as a reason to start getting financially educated. Because we are taught in our economic system to go to school, get a job, and work as an employee. But in this system, in this economic system, in this capitalist system, there are two ways that you can get paid. You can get paid from your job, aka your labor, or you can get paid from your capital. Our entire education system is designed to teach you to learn and to earn from your labor. Period. You go to school to learn to get a job. Period. But in this economic system, in this capitalist system, the people who make the most money are not the people who earn it from their jobs. It's people who earn it from their capital, meaning you earn it from what you own. That is how you win in this economic system. Now, the reason why this makes so many people upset is because we're never taught this. And I feel you. When I learned about this the first time, I was very upset too, because I went through a lot of schooling. I went through high school, I went through college, I went through a year of graduate school, and then I went through law school. And never once did I learn a thing about money or investing or passive income or building wealth. So I get it. But now, let's go to the way that our system works. Our system is designed this way, which means that the people who become the wealthiest are the people who earn from what they own, not the people who earn from what they do. But we're only taught to earn from what we do, which means you got to continue doing to get paid. You get that paycheck. Then what do you do with that paycheck? If you blow all that paycheck, you are contributing to growing the economy. Thank you for your service. But it does not grow your wealth. Our economic system grows when you spend money. It grows even faster when you go into debt to spend money. But it doesn't grow your wealth. If you want to grow your wealth, you have to do things a little bit differently. Now you have to work to earn. And then instead of spending all that money, you got to take a piece of that money and then you got to invest it into assets. The things like I've been talking about, stocks, real estate, businesses. You want to take the money that you're working to earn and invest it into places. That way you can grow what you own. That way you can get paid from your capital, meaning your money, instead of just your labor. Once you start to do that, that's how you can start to grow your capital investments. You work to earn money, but why are you earning money? The average American is working to earn money to buy things. This is why the average American will never be able to build true financial freedom or wealth for themselves. Because if you're working to buy things, you're working to make everybody else around you rich. But if you really want to become rich yourself, you have to become a completely different thinker. You have to work not to buy things, but you have to work to build your wealth. And now if you want to work to build your wealth, it doesn't come from your salary, it comes from what you own, which means you have to work to buy assets. You are working to buy assets, period. If you are working to buy assets, you will be able to become wealthy because now you're going to work to get paid. That way you can buy more assets. This might be stocks, this might be real estate, it might be businesses, whatever it might be, but you're going to work for one reason, to buy more assets. The more assets you can accumulate, the more wealth that you can build, because these assets can continue to pay you even when you are not working. And then if you continue to work to accumulate these assets, well then these assets can also pay you to live your lifestyle. And if you do it correctly, well, and you do this long enough and you continue to put in the effort, you work to earn more money so you can buy more assets, eventually you will hit a point where now your assets will be able to buy you the lifestyle that you want, and you no longer have to worry about the money because your assets are working to earn you more than you are from your job or from wherever it is that you're running. That is true financial freedom. And if you want to worry about what's going on with the de-dollarization, then the proper diversification can help you with that. Proper diversification does not mean diversifying your money in your stock market portfolio. To the average person, diversification means I own a blue chip ETF. I own a dividend ETF. I own a REIT ETF. And I own an innovation ETF. The problem with that is they're all paper assets. That's not true diversification. True, real diversification is you own some paper assets like stocks. You own some cash flow producing hard assets like real estate. You invest in something like maybe a little bit of physical gold. This is now true diversification because now you're diversifying your money across different asset classes. But in order for you to do that, you need to, one, get financially educated, and then second, you have to change how you're using your money. Because if you're spending all your money, it doesn't make a difference what your education is because you have no money to actually invest. You have to start using your money as a tool instead of as a fool, which is kind of a funny rhyme that I created. But you have to start using your money as a tool. That way you can use your money to make yourself rich so you can make yourself wealthy before you make everybody else around you successful. And the unfortunate reality, it sucks, but the way that our economic system designed is that it is profitable to keep you broke. It's profitable to keep you in that system where you're just spinning your wheels, working to earn money, going into debt to buy things, and then wondering why you're never wealthy yourself. It's profitable because, well, that means you spend more money. The more money you spend, the more money somebody else makes. What I'm saying is flip it around. Use that money to make yourself rich first. Then when you get that richness, then yeah, by all means, go out and buy whatever you want. I'm not saying don't buy the nice things. I'm saying make sure you can afford it first. Make yourself rich. That way you can afford to buy whatever nice things that you want. That way you can actually enjoy the money without stressing about money. Because one of the strangest things that happen is people go out and they buy a brand new car and they talk about how much they love the new car. And then 3 weeks later, they start complaining about gas prices. Oh my God, I can't believe gas prices are this high and I have to put premium gas in my BMW. And then 2 months later, they start complaining about the car payments. Man, these car payments are hard, and then I got to pay for insurance, and I got to pay for the maintenance on my BMW. Do you know how much it costs to get an oil change on my BMW? You work hard to get the car, you struggle to pay the gas, you struggle to pay the maintenance. Instead, flip it around. Drive a Toyota Corolla with cash, which doesn't have the premium gas. Hopefully it's in good working condition, so you don't got to keep getting that expensive oil change, and you don't got to worry too much about the maintenance. Invest the money instead, buy the assets, then let the assets pay for the car for you. And now you don't got to worry about the payments and the expenses as much because you have the assets that are working to spend that money. They're working to earn the money. That way you can spend it without having to worry about the price. But it requires a complete shift in the way you think and the way that you use your money. And until you take the first step to take action, to one, believe it's possible, and then actually start learning. You can start, it's so much more accessible now because YouTube has made learning about financial education so much easier. Because back when I started learning this stuff, when I first started learning about money, because nobody in my family told me what investing was. Nobody in my family knew what real estate investing was. No, I had zero financial education. The only financial education that I had was I got to become a doctor because if you're a doctor, you can earn a big salary. And if you earn a big salary, you can become rich. That was the extent of my financial education. When I started learning, I had to read books, and I hate reading. English was my second language. I never read. I did really bad in English. So I started reading. And the first book that I ever cover read was a book about money. It was called Rich Dad, Poor Dad by Robert Kiyosaki. And then I started learning about this idea of investing in money, which I'd never been exposed to before. Then I started reading books by Dave Ramsey, Total Money Makeover. I highly recommend anybody getting started with their financial education, start with those two books, Rich Dad, Poor Dad, and the Total Money Makeover. Rich Dad, Poor Dad is by Robert Kiyosaki. Total Money Makeover is by Dave Ramsey. Two completely different points of view, but talk about money in completely different ways that you need to understand both of. And then I started just reading more and more books about entrepreneurship and financial education, and then I started doing it myself. But this is where, yes, you got to go through that emotional curve. The first time you learn this, you probably will be upset and angry, but then you got to learn the rules to the game, because if you don't learn the rules to the game, you will continue to be a pawn in the game, and understand that there's a lot of craziness happening in the world with high inflation, with the economic slowdown, with higher interest rates, with de-dollarization, but everything creates opportunity. There's always opportunity to be found, and unfortunately or fortunately, depending on how you look at it, the bigger the craziness, the bigger the opportunity. The bigger the pain, the bigger the opportunity. So now, when you understand this, the question is, what do you do? If you get prepared and you educate, meaning you start to work to use your money smarter, and then you work to build your financial education, when you see the opportunity, what do you do? Can you capitalize on it or not? And if you can capitalize on it, well, then you can then have the ability to build insane amounts of wealth, but it requires you to understand the system and what's going on and how to be prepared, because reality is it's going to happen. There are always going to be periods of opportunity. There's always going to be periods of economic pain. That will continue to happen. Some people will use it as an opportunity to build wealth. Some people will get hurt because of it. Which side do you want to be on? And this is where now, we can either be righteous or you can be right. And I don't know who said that. I read that somewhere in some book. But, there's a lot of craziness in the world. And what I'm trying to get you to understand is, look, this is the system. This is what's going on. This is the reality. These are the red flags. Prepare. If nothing bad happens, oh well. You got a big bank account. If you see opportunity, well, then you can capitalize on it because now you're prepared and you're financially educated to do so. So now the question is, which side do you want to be on? And how are you going to start preparing? And that financial education now is thankfully so much more accessible than ever before. We are in the calm before the recession storm. At least that's according to Jamie Dimon, who is the CEO at JP Morgan Chase Bank. Every year, JP Morgan puts out their own annual statement where they talk about their opinions of what's going on in the economy, their worries about the economy, what they think is coming in the economy, and then Jamie Dimon also